Welcome to this presentation. I'm Ajoy Basu. We continue to explore in this series created especially for the business person, unraveling important points regarding key financial parameters when reviewing the state of affairs of the business. These points are culled out from the modus operandi followed by me when performing as a meeting jockey in such review meetings. Today, the torchlight is trained on profitability. I trust you'll find this to be informative and interesting. The term profit has myriad connotations. Let's go to gross profit first. Gross profit margin is a metric computed by deducting the cost of goods sold. Cost of goods sold we normally express by the acronym COGS. So, by deducting the cost of goods sold from the entity's net sales, the gross profit margin shows the amount of profit made before deducting selling, general and administrative costs and overheads from sales. So, the gross profit margin is then divided by sales to arrive at what we call as the gross profit ratio. Higher the gross profit ratio, better it is for the business. An important index of profitability of the business. Operating profit is gross profit less overheads. Operational and sales related expenses also are deducted to arrive at the operating profit. These are expenses which are necessary to run the business. It also includes depreciation and amortization costs of assets in its fold. The key principle is that these are incurred to run the operations of the enterprise. Then we come to the NPBT, the acronym NPBT, which stands for the net profit before tax. As it indicates, tax is not considered, that's why it's called before tax, but it considers all other expenses and accounting related entries which are deducted from the gross margin to arrive at the net profit before tax. So closely allied to that is the net profit after tax, which is the NPBT, but now we consider even the expense of tax to arrive at the net profit after tax. Then we have one more acronym, that is the Ebitda. Ebitda indicates the profit of the company before paying the interest, taxes. Interest is your financing cost, so that's excluded from Ebitda. So it's before paying the interest, taxes, depreciation and amortization. You then have the cash profit, which is the net profit after tax, to which you add the depreciation and amortization, the non-cash items in your revenue statement or the income statement. This term considers that depreciation or amortization is not a cash expense and is a book entry to write off a part of the fixed assets or certain other non-cash expenditure. Therefore, Ebitda measures profits without considering financing costs such as interest. It is also not considering accounting entries related to depreciation and amortization and also your tax liability. Ebitda is used to measure a company's operational profitability because it takes into account only those expenses which are directly connected with the running of the business on a day-to-day basis. Investors tend to watch the Ebitda very closely as it is easier to analyze the profitability between companies because it removes the impact of financing and accounting decisions. Ebitda can also be used to compare the profitability trends of capital-intensive industries like engineering companies to technology-based companies because it separates the impact of interest expense and depreciation from the valuation. If you don't separate them, you cannot really compare an engineering industry with that of say a tech industry. I mean, the dynamics are so different. The moment you separate them, you can look at them through the prism, through an evaluation process on statistics which can be compared. Well, Ebitda as a concept garners a lot of attention. There is a risk inherent which you need to factor in. A positive Ebitda can sometimes be misleading if it is considered as a complete index of profitability and cash sufficiency. Concentrating entirely on the EBITDA may result in ignoring the cash requirements for expenditure or for provisions which tend to be ignored in its computation. For instance, by ignoring depreciation or amortization, you may tend to ignore that you need enough cash to replace the essential capital assets to operate the business. That is what that write-off of depreciation or amortization is what points out towards that direction. You need to plan for the replacement of assets which are tending to get aged or obsolete. While steering such meetings, review meetings, I am careful to point out and discuss this perspective at length so that the stakeholders have the clear understanding that a positive EBITDA does not necessarily translate to the enterprise level profitability and solvency. It is important to establish the fine balance between the enterprising finance functionary's perspective and that of the conservative accountant who may be a bit regulatory in his thinking. Always better to read the Ebitda along with the cash flow statement and even the cash flow forecast. I tend to do that when I work on review assignments. Cash profit involves adjustments to book profit relating to depreciation and other non-cash items. It has to be kept in mind that the accrual system of accounting is more holistic and reflects the state of affairs that much better. But that aspect of thinking is from a different perspective. So while we have grappled with the myriad connotations of profit, we need to understand that under most accounting standards, the gross profit margin, operating profit margin, and the net profit margin are terms which are widely recognized. Ebitda is a favorite buzzword of the investor and the finance analyst. We move on to the next slide. The chain of profitability starts with the gross profit. My gross profit margin will be better if I manage to get higher prices when I sell my products. Of course, my product attributes, including quality considerations and the market dynamics, largely determine at what prices I can sell. I emphasize on comparing the gross profit ratio with those of the earlier periods and also to the industry trends. A widely fluctuating gross profit ratio would indicate unstable practices and possibly even serious gaps in capturing, recording, and accounting the cost, classifying the cost into direct, indirect, fixed or variable. We need to be quite wary of that. As companies tend to have multiple products, I strive to convince my client to generate product-wise gross profit figures for the major products in its product mix. There is a whole lot of pricing strategy and direct cost implications which one needs to grapple with to get the gross profit margins optimized. An interesting and challenging area for both the expert and those in the management. We need to grapple with it all the time. Here the concept of operating leverage also needs to be discussed. Operating leverage measures the extent to which a firm or a project can increase operating income by increasing the revenue. When a firm has high operating leverage, it generates sales with a high gross margin and low variable costs. Low variable costs would imply higher fixed or non-variable or recurring costs which add to the operating risk of that enterprise. We have a close look at the operating leverage of our clients when we try to help them design the financial model. The next rung in the cycle of profitability is the quantum of overheads. The recurring costs to run the business. Cost effectiveness assumes paramount importance, particularly where the size of the overhead justifies the scale of operations is the moot question that we always try to address. In this context, I derive a lot from the headcount and overhead profile of the peers who are performing very well in the industry. The role of technology to cut costs, albeit at the cost of maybe some capital investment too, is considered. Outsourcing and make or buy considerations are examined from time to time to ensure that the economic engine which drives the enterprise is an appropriate and optimized one. We then come to the break-even point. The break-even point is the point at which the total cost and total revenue are equal. It is a point at which there is no net loss or gain, where we can say the total cost and the total revenue are equal. Lower the break-even point, better it is for the business, as the generation of profit is greater in that situation. Closely allied to the break-even point is the margin of safety, which is equal to, if you have to compute that, the formula is you have to deduct the break-even sales from the current sales and then divide it by the current sales, and you get that percentage. A higher margin of safety provides greater comfort to the organization. An important concept, the break-even point. In this slide, we discuss about profitability in terms of the returns it fetches on investment. So whereas in the earlier parts of the discussion we concentrated on the absolute figures of profit and its correlation to sales, here we are linking it to the investment made in the business. Investment too, like profits, have different connotations. Return on equity, normally the acronym used is ROE, is a metric of financial performance calculated by dividing net income by the shareholders' equity. The shareholders' equity is the same as the shareholders' net worth. It is also considered, this ROE, as a return on net assets. Another concept, the return on assets. Return on assets is a useful indicator to gauge the profitability of a company relative to its total assets. Return on assets provides the analyst with a good idea as to how efficient a company is using its assets to generate earnings. We then come to capital employed. Let us understand how do we calculate it. The accountant's simple definition for it is the total assets minus the current liabilities, that is the short-term liabilities. In practical terms, it considers both the equity capital as well as the non-current liabilities under capital employed. The concept is therefore wider than equity or net worth. So for an organization which has a high debt component, the return on capital employed could be significantly lower than the return on equity. Studying the correlative interplay between the return on equity and the return on capital employed provides a very good insight into how good is the recourse of the business entity to financial leverage. The cost of such borrowings and the returns it extracts from such mobilization and deployment of funds provides very good fodder for that analysis. The concept return here refers to the earnings before interest and taxes, what we call as the Ebitda. For a small medium entrepreneur who aspires to scale up in time and is committedly pursuing his dreams, he needs to be on top of these concepts and should fully understand. I believe it as a mentor and a trainer, I believe that it is imperative that he is on top of these concepts and understands its practical relevance. I trust you have enjoyed this capsule, a special one which makes you look at profitability through the prism of good business acumen.